This Wednesday sees the final interest rate decision from the FOMC of 2025, and markets are going into it with high expectations. That's because we have, of course, question marks around the direction of travel for the jobs market, and by and large, inflation has been under control under Donald Trump. Well, what should we expect for this meeting? What's the outlook for rates beyond that? What are the kind of market movers that could happen within this meeting? And what are the side sort of theories behind why we might see particular movements for the likes of equity markets, the US dollar, and gold? Let's get into that and more within today's video. Now, first and foremost, it's worth noting that we're coming into this announcement and decision with a lack of data. Of course, the record shutdown that has taken place recently means that we've seen some data just entirely removed from the calendar and some released belatedly. So as you can see here, jobs data cancelled, inflation data lost, jolts data delayed, jobs data delayed, inflation delayed. And much of it, crucially, comes after this FOMC meeting. So you might think that the Fed, given the fact that they're very data dependent, will essentially just take a cautious approach and say, well, until we see all this data, we're going to hold off. And certainly what we saw previously under Donald Trump, where he enacted a number of these different tariffs, or at least threatened to enact them, was the Federal Reserve essentially just said, well, we're just going to hold off and see exactly how things play out. Now, he has signed deals with a number of different countries, which means that essentially a lot of the risk has been taken out in terms of potential sort of upside in terms of inflation owing to tariffs, but also quite a lot of time has passed since then, and we haven't really seen a major uptick in terms of inflation pressures since those tariffs have come into play. That allows the Federal Reserve to be able to look back at that data and utilize that rather than simply saying, well, we need to see the data that's missing because it might not be forthcoming. And certainly when you look at the Federal Reserve, they have a dual mandate. They need to keep the jobs market under control. They need to see inflation around target. Now, inflation's above target, but the jobs market is weakening. And so they need to take a decision. And by and large, it appears to be the case that many within the Federal Reserve think that the risk to the economy is the greater risk. And I think it's probably right to say that. And we'll look into that data. So by and large, for markets, the pricing for a rate cut this time around is 87%. What does that mean? It means it's very, very likely we see a 25 basis point cut. For one reason, the Federal Reserve don't like to incite volatility within markets by going against expectations when they're as high as this. So that will push members towards cutting rates. But also those sort of expectations are informed by the commentary that's come out from many of the different members themselves. So the members will drive expectations. And so those expectations are not only a reflection of what those members have said and the data that's come out, but also the fact that those members will by and large go in favor of what markets are expecting if it's as heavily in this favor. So that makes it very, very likely that we're going to see a rate cut this time around. But that's not necessarily the only part of the story, really, because it's worthwhile noting that essentially there's a pathway for rates, and whether you see the rate cut this time or whether it comes in January probably isn't necessarily the be all and end all, because ultimately if rates are going to end up at 3%, whether we see a move down to sort of 350 this time, or whether we see it in January and we ultimately get down to 3% at sort of midway point of next year, it's pretty much the same thing. It's not a huge difference. And so if you're looking at market volatility, you might say, well, a rate cut probably isn't going to move the needle. And the reason for that is because markets are priced in, right? Markets are forward looking. They don't necessarily say, oh, well, we think there's 87% chance that there's a rate cut, but let's wait until we actually see a cut, and then we're going to be completely surprised, or at least act completely surprised when it happens. That's not what will happen. So markets have by and large priced the rate cut in, and so you start to look at some of the alternate drivers. let's look at the outlook for the longer term. And like I said, you can see here, there's one rate cut between now and Q2 that's expected. So if we see a rate cut in December, markets are pricing, by and large, no rate cuts for the additional meetings, although essentially the March meeting is a coin toss, right? It's essentially 50-50. So we could see another rate cut in March, but then that's just bringing forward the next phase where you see another period where you see rates expected to remain at 325 to 350, and then potentially moving into 3% to 325 band by the end of the year. So by and large, if you do see a rate cut this time, markets are only pricing 2 rate cuts next year. That is particularly notable, and that's where we can see significant movement, because the meeting that we're looking at this time comes with projections and forecasts. So that can change expectations, as we see here, and that shift in pricing can move markets. But also things can change pretty swiftly, because we're going to see a change at the top at the Federal Reserve, with Jay Powell likely pushed out in May, and Trump essentially getting someone in to do his bidding. He's already got Stephen Mirren in the Federal Reserve, and what's he done was voted for a 50 basis point cut every single time. He is the outlier, and that shows essentially what Donald Trump expects from someone that he brings into the Federal Reserve. Well, Stephen Mirren was essentially the canary in the coal mine. That was him trying to sort of fire off an early shot, but the big ticket move that he's going to make is to appoint someone to the Fed chair role. If he appoints the right person, they're going to be able to influence the group and drive down rates and potentially ease in a different way. You know, there's question marks around demand for US treasuries. They need to drive down borrowing costs. So that means lower rates are needed. That means the potential for QE at some point. So there's plenty of easing that could happen if he chooses the right person and if they are able to influence the Federal Reserve in the right way. But right now, markets are pricing a very conservative pathway forward for rates. And by and large, that is a good thing, because it's notable that this is probably going to change in the direction of additional easing, data dependent, of course. In terms of the data, you can see here, this is the monthly inflation data out of the US. And what I wanted to show you really is the fact that if we're looking at the monthlies for the core PCE, which is the favored metric that the Fed rely on, March onwards, inflation has by and large been under control. Remember, that's when we saw Donald Trump coming into power. And so essentially you're looking at a question mark about whether the tariffs are inflationary. Well, according to the core PCE price index, they're not inflationary. And that means that the Federal Reserve can act based on the data that they do have and ease this time around and potentially take a more constructive tone looking further out. Notably, the most recent ISM data coming out of the US has seen some downside coming in the prices paid element, crucially within the services part in particular, because that's the area that had proved problematic. And if you look at the 3-month annualized figure for the core PCE, inflation hasn't really been ticking higher over the near term, as we saw with those monthly inflation metrics. So inflation, by and large at the moment, appears to be relatively under control. Then you look at the jobs market, you can see unemployment gradually moving towards the upside. And certainly, if you look at the payrolls figure, it has been on a downward trajectory, albeit part of that is a normalization of the pretty significant volatility we saw around the pandemic. But bear in mind that historically, normal or strong figures are around between 100 and 200K. That's certainly not what we're seeing at the moment. And we're also seeing weakness in other areas of the jobs metrics, the likes of the JOLTS job openings continuing to decline, the likes of the ADP payrolls coming in weak as well. So gradual rises in terms of unemployment, weakness across many different jobs metrics really provides the basis for the Fed to move now. But like I said, things I think are likely to change as we move forward, in part because of the shift we're going to have at the top of the Federal Reserve. Now, part of why this is a particularly notable report is that every few months, when we see the Federal Reserve provide their rate decision, it comes alongside forecasts, so projections for a number of different things. As you can see here, where they expect real GDP to go, the unemployment rate, the core PCE inflation metric, and interest rates. So you can take the lead and say, oh, we've seen an expectation that unemployment is going to be higher. That means they'll be more proactive, or they're now projecting that inflation is going to come down quicker and therefore they'll be more proactive, or the opposite. Or you can just look at the dot plot and try and map things out and see exactly where those shifts are going to take place. Notably, if you look at this dot plot, what is significant is that we've seen quite a wide spread in terms of views. And that comes in line with the fact that the Fed are dealing with a dual mandate, that they've got problems on both sides, right? They've got weakening jobs, but rising or elevated inflation. So it's difficult as a member to know exactly which one to prioritize. And that's part of why you're seeing these differing views. But then you also have the curveball that is Stephen Mirren coming in, and he's always going to be the most dovish of the lot. So it's likely that we're going to see a spread in terms of the outlook, as you can see here for the September dot plot. But certainly this gives you a good guide on whether the potentially 2 rate cuts currently being priced in by markets for next year is too cautious. And if that is the case, then this dot plot and the adjustments to the dot plot could be the thing that essentially sets significant movements around this report in particular, rather than the rate cut itself. Because like I said, much of the rate cut is priced in. What isn't priced in is the moves in terms of the dot plot, if they are significant. Maybe they're not. Maybe they're very similar in terms of the outlook to last time around. But if we see significant change, then that shifts the narrative around how many rate cuts are going to come, where the terminal rate will be, and things like that. So that's where volatility could come at this meeting. Like I said, I think this is going to be more important as we go forward as well, because if we get someone at the helm of the Federal Reserve that's able to move the group, then you have question marks around the independence of the Federal Reserve. You have question marks about whether they're taking decisions that are counterproductive because they're inflationary by nature. They prioritize growth for Donald Trump against the stability of the US going forward. But also has a potential impact in terms of the bond market, where you would see lower yields on the short end of the curve because we're seeing rate cuts coming into play, but then rising longer term yields on, say, the 30-year, because people are fearful about a resurgence in inflation and concerns about the stability of the US economy, because they've got a Federal Reserve that essentially is politicized. So there's a lot coming down the line. But I think for one of the big sort of announcements out of this report, the dot plot will certainly be one of the sort of ports of call for you to jump to when you first start to look at the details that come out around this announcement. So let's just quickly jump onto the charts. So first of all, here is the chart for gold, and we can see that gold from a long-term perspective, of course, it has been doing very well. Now, what does well when we see rate cuts? Generally, gold does. Certainly, if I was to add on another chart and go to the Fed funds rate, there we go. We'll go new price scale. I'm going to get rid of silver just so I don't have one of those. So if we're looking from a long-term perspective, at times where we see rate cuts coming into fruition. So let's see here. We've got rate cuts starting here, and you see the market basing out. You then see a rise in terms of rates. Then you see another rate cut sort of inception here, and you see that beginning of a protracted bull run here. Similar kind of thing here. When you see the beginning of the rate cut cycle, that's when this big multi-year basing phase ends and we see a move higher. And so the fact that we've cut rates here and we've boosted higher comes as no surprise. We're continuing to cut rates, and therefore, you know, if you look at previous instances where you're in the middle of a rate cutting cycle, I mean, we still had plenty to go ahead of us. You know, similar kind of thing here. We saw it. Same kind of thing here. When you're in the middle of it, it still had plenty to go. We did see some consolidation after a bit there. But so that makes me feel like we're likely to see further gains to come from the precious metal space. Now we're seeing some chop because we've seen this major rally. We're now seeing a sort of protracted period of consolidation. But as you see here, we pull back, we're creating higher highs and higher lows. So whilst we're sort of consolidating at the moment, unless we see a breakdown through this near-term sort of 4,000 mark, essentially, then any of this sort of mucking about at the moment, in my mind, is a retracement phase before the bulls come back into play. We're seeing some support at the moment at sort of 41.74, 41.64 kind of area. But certainly if we break the 42.20 kind of area, 42.19, then maybe that's the thing that sets us higher once again. But like I said, I am sort of fairly cautious of the idea that we could maybe move into some sort of consolidation phase. But certainly if we move towards that sort of position where the Federal Reserve are cutting rates, despite the fact that maybe they shouldn't be doing so because it's raising inflation fears, and that's because of who Donald Trump has appointed to the White House, that I think could really spur another strong move towards the upside in terms of gold and weakness in terms of the dollar. So for this meeting, I think it's not necessarily just going to be the rate cut that's the question mark. It's what's the outlook for January, because of course you still do have concerns around the jobs market. Is this them for a while if they cut rates? If not, then maybe people start to price in the possibility of a rate cut in January as well. So look out for question marks about how concerned they are about the jobs market and how much they feel that they need to act to try and rescue it, essentially. But beyond that, look out for the dot plot, and that should help price things out a little bit further out down the line. In terms of the US dollar, the dollar index has been regaining some ground. Notably, you can see that we're actually sort of pulling back a little bit here. Here we go. That'll be off the back of the JOLTS job openings figures, I'm sure. But certainly, you know, whilst we're regaining a bit of ground here, I do think that what we're seeing at the moment is a sort of consolidation phase. And if we do start to move towards a period where the Fed are cutting rates, all the other central banks have essentially got rates to where they think should be that sort of terminal rate, and keeping it there and staying steady, and we see the likes of the Federal Reserve continuing to cut, then that could spark another move towards the downside for the US dollar in a meaningful manner. For the near term, like I said, look out for that dot plot. We have got the possibility of a resurgence in terms of the dollar if we see a relatively hawkish tone taken this time around, or a patient tone, because of the fact that much of the rate cut is already priced in. But I do think that even if we do see some near-term strength, I don't necessarily think it's going to last too long, certainly as we see question marks around the independence of the Federal Reserve and the direction of travel for rates in the US in comparison to some of the other central banks that are likely to cut to a certain point and then stop, while the Federal Reserve could continue to cut if the person at the helm is essentially just doing the bidding of the president rather than the needs of the Federal Reserve and remaining independent. Then finally, looking out at the equity space, of course, we saw this significant pullback. We came into this support level around about 23981, and we've been regaining ground since then, crucially rallying up into the 25721 swing high. Now we're seeing a little bit of sort of profit taking here, losing a bit of momentum. You can see here it's sort of rounded quite sharp at the beginning, and now we're sort of gradually sloping out. Now you could say that sort of right shoulder for a head and shoulder formation. If we start to break down through support here of 25538, then, you know, do you start questioning whether this is sort of buy the rumor, sell the facts scenario? Like I said, we know that there's going to be a rate cut essentially. So if we do see a rate cut, but a cautious tone and a dot plot that maps out 2 rate cuts next year, then maybe people are a little bit underwhelmed by that. So certainly be aware of that possibility. At the moment, markets have regained so much ground that we're not that far off record highs, and we're coming into this resistance level. We've got the possibility of a head and shoulders formation with a breakdown to 5538, signifying that coming into fruition. But yeah, we are still regaining ground, but certainly losing a bit of traction at the moment. And if the rate cut has been the driver of people to be optimistic, then leaving that behind and moving into a period where you've got to wait months for the next rate cut maybe might make people think and become a little bit cautious over the near term. Of course, we're moving into Santa rally territory. We've moved behind it, moved beyond an earnings season that has been a very strong one for US companies. And so the question mark here is, can we continue to rally? We can, but we're losing a little bit of traction at the moment. And there is a fear that we could see a little bit of profit taking once the rate cut comes into fruition, if we don't see a particularly optimistic outlook in terms of rates for 2026 in terms of the dot plot. The caveat is that is not going to account for the reality once we have a new chair at the helm. The reality might be that the Fed members essentially are like, well, we're independent and we're not going to be influenced and we're going to make the right decision either way. And in which case, maybe that person doesn't manage to shift the narrative, but maybe they do. So there's going to be some fireworks ahead for us to keep on top of. I hope that's been useful. Make sure to like, subscribe, and follow for more. We're going to be providing plenty of content towards the back end of the year with some previews for some of these key markets in particular. So keep an eye out for that. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day, and good luck trading, particularly around the FOMC announcement on Wednesday.